At present, the total debt of the U.S. government exceeds $34 trillion. You've heard that number from every cable host, every politician running for office, every person seeking doom and pessimism. But few tell you that about $6 trillion in debt is owed to the government. Not China, not Japan, not Wall Street, hedge funds. The U.S. Treasury borrowed from Social Security, Medicare, and federal employee retirement funds, and sent them back, IOUs. The government has $6 trillion on its own books. But when Congress fights over the debt ceiling, when credit agencies threaten to downgrade the country's sovereign debt, and when your favorite financial expert yells at the looming fiscal cliff, few come up with the number to explain what it really represents. Today, we have sounded the most misunderstood and arguably most dangerous national debt, not because it is owned by foreign adversaries, but because it represents the government's commitment to you, your retirement, your health care, pensions for every federal worker, every soldier, and every mail company in the United States. This is the story of internal government control. When we redone, you'll understand what 99% of Americans don't understand. What happens when the government borrows from its piggy bank? And what happens when the piggy bank starts to run out? Let's get started. Understanding the Treasury Department's definition of total national debt as public debt plus debt held within the government divided into two completely different categories will change your view of each fiscal heading. The first barrel is public debt. These are Treasury bonds, bills and bonds purchased by outside investors, domestic mutual funds, pension funds, banks, insurance companies, individual investors, foreign governments, foreign central banks, and so on, all participate in this market. By early 2025, the public held about $28 trillion in debt. This is real market-traded debt that fluctuates in the open market, has yields and responds to Fed policy, inflation expectations, and global risk appetite. When commentators debate who owns American debt, this is what they call a bucket. The second barrel, which we are focusing on today, consists of about $6 to $6.5 trillion in non-price Treasury bonds held in various federal government trusts and accounts. The securities were never traded on the open market. You can't buy it. Goldman Sachs can't buy it. And neither can the Bank of Japan. They exist purely as accounting tools in the federal government's own books. The reason the government owes itself money goes back decades, and the mechanism seems simple. When some federal program, Social Security, is the largest earn more than benefits in a given year, surpluses don't just exist in vaults somewhere. Federal law requires these surpluses to be invested in specially issued Treasury bonds. The Treasury will use the remaining cash for general government operations and issue a special government bond to a trust that earns interest and is backed by full trust and credit in the United States. Social Security has operated this way since 1939. Dozens of other federal trusts followed the same pattern. Over the decades, the IOUs accumulated trillions of dollars in value. Here is what you need to know. From an accounting point of view, these are real obligations. Social Security trusts have legal rights to these securities, just as bondholders in Tokyo have legal rights to 10-year Treasury bonds. The full good faith clause does not distinguish between internal and external creditors. But from a cash flow perspective, these holdings operate very differently from public debt. When the Treasury needs to repay foreign bondholders, it must come up with real money. When the Treasury Department needs to repay Social Security, one government department is paying another. Cash still has to come from somewhere, whether it is taxes, new borrowing, or spending cuts. But the deal is still internal. The tension between legal obligations and cash flow realities has been at the heart of nearly every political battle in Washington over welfare, debt ceiling, and fiscal sustainability over the past 2 decades. So let's look at this $6 trillion piggy bank and see who owns what, because Social Security gets all the attention. But the story is much deeper than one project. More than 200 separate federal accounts hold internal government debt, but the vast majority of the balance is concentrated in a handful of major trust funds. Social Security trusts dominate the list. Not even close. Technically, this category consists of 2 funds: the Old Age and Survivors Insurance Trust OAC and the Disability Insurance Trust D. Together, the 2 funds hold about $2.6 trillion to $2.7 trillion in specially issued Treasury bonds, making them the largest holdings within the government. For decades, Social Security ran a persistent surplus, with income from payroll taxes flowing in more than welfare spending flowing out. And every dollar in the surplus was converted into these special bonds. The political class views surpluses as free money, using them to finance everything from defense spending to highway projects to what Congress wants without raising visible taxes. Next came the Defense Department's Military Retirement Fund, which holds hundreds of billions of dollars in Treasury bonds, earmarked for military retirement benefits for each active duty soldier, sailor, pilot, and Marine who has served long enough to earn a pension. Future payments are supported by assets in the fund, the Federal Employee Retirement System, and the Senior Civil Service Retirement Disability Fund. Together, hold more than $1 trillion. The funds cover the pensions of millions of current and former federal employees, from IRS agents to National Park Rangers to passport applicants. The Medicare Hospital Insurance Trust, which covers Part A, holds hundreds of billions of dollars, though its balance has been declining for years as spending continues to exceed payroll taxes flowing into the fund. Small funds circle the long tail, including dozens of funds, such as Highway Trust Fund, Airport Aviation Trust Fund, Nuclear Waste Fund, various Veterans Welfare Funds, and Postal Retirees Health Welfare Fund. Now look at the list: Social Security, military pensions, federal employee pensions, Medicare. These are not abstract financial instruments. These represent retirement guarantees for hundreds of millions of Americans. When politicians casually say that our debt to ourselves doesn't really count, they're actually saying that the retirement commitments made to every American worker, every soldier, and every federal employee don't really count. Once the packaging is opened, the meaning of that sentence is very different. That is where politics gets ugly. Because there is a persistent narrative in both parties that the assets held within the government are somehow less real than the debt held by the public. Some argue that because this is an internal government transaction, its function is more like an accounting fiction than an actual obligation. There is a core of truth, because economic dynamics are indeed different. But it is completely wrong to argue that these obligations can be squandered, restructured, or ignored without consequences. Let me tell you exactly why. For much of the late 20th century, shareholding within the government worked well. At least on paper, Social Security has run surpluses, which have gone to general government spending and trust funds, have accumulated assets, an arrangement that seems to satisfy everyone. But there is always a ticking clock in the system. And that clock is demographics. About 7.6 million American baby boomers, born from 1946 to 1964, spent decades paying for Social Security and Medicare. Their payroll taxes create surpluses that create the balance of these trusts. The oldest baby boomer has been 65 since around 2011. And about 11,000 Americans now reach retirement age every day. Math here is ruthless. More retirees mean more benefits are coming. Fewer workers per retiree means less payroll, tax income per dollar of benefits. As actuaries predicted 40 years ago, the result is a trust fund moving from surplus to deficit. The Social Security OAZ Trust began running a cash flow deficit in 2021, which means the program is beginning to pay more benefits than payroll taxes. To make up for the shortfall, the trust began to redeem specially issued Treasury bonds, which in simple English means that Social Security began to be cashed in white notes. Think about what that means. When Social Security redeems bonds, the Treasury Department must come up with actual cash. There are 3 options for cash: raise taxes, cut other spending, or borrow from the public. There is no 4th option. And money doesn't come out of nowhere. The reality is that internal government debt is turning into public debt. The total amount of Treasury bonds remained unchanged, but the composition changed significantly. The shift from internal IPO to Treasury bonds sold to outside investors has real consequences because publicly held debt creates real interest costs to truly outside creditors who compete in the federal budget with every spending priority Congress has. The 2024 report of the Social Security Trustee predicts that the combined OAZ and DI trusts will be exhausted around 2035. Exhaustion does not mean Social Security is gone, because payroll taxes will still flow in. But the plan covers only about 80% of plan benefits. That would mean a full 20% cut for every retiree in the United States, unless Congress intervenes by that date. Medicare as part of hospital insurance trust faces more immediate problems, and trustees expect funds to run out around 2036. Although some analyses suggest that funds may be available faster based on trends in medical costs in the coming years. Here are some issues that deserve your full attention. The cumulative rate of publicly held debt has accelerated sharply as these trusts have shrunk. According to long-term projections from the Congressional Budget Office, this has nothing to do with deficits caused by discretionary spending or tax cuts. This is a structural shift, with trillions of internal debt coming due and having to be financed from outside. This is a hidden time bomb inside the national debt. The $6 trillion held within the government is neither fake nor meaningless. These holdings represent a form of deferred debt maturing. The bills are coming, and the government must pay them. Now let me show you how this whole thing is politically weaponized, because that is where you really need to keep your eyes open as citizens and investors. 2 mainstream narratives about ownership within government have circulated, leading to false conclusions. The first narrative sounds like this: real debt is only $28 trillion, not $34 trillion. Those who want to minimize the severity of the debt situation are pushing for the framework. Their view is that because the assets held within the government represent the money it owes itself, they offset the debt on its consolidated balance sheet. This view exists in very narrow technical accounting. if each federal entity were consolidated into a single balance sheet, as in corporate accounting, the parent company and its subsidiaries would be consolidated. The net asset value held within the government would be zero. Assets on the Social Security books and liabilities on the Treasury books will offset each other. But this logic completely ignores the legal and political reality that these trusts represent commitments binding on real people. Social Security Trust is not an abstract accounting entity. This is the mechanism by which 200 million Americans expect retirement income. No debt, no mortgage, because your checking account and loan happen to be in the same bank. Banks may see it as an internal purge, but you still owe money. The second is the opposite. Social Security is going bankrupt and will no longer exist after retirement. The framework is similarly misguided. The expiration date of the trust fund does not mean that the Social Security will stop running, even after the trust is exhausted. The continuing payroll tax income will cover about 75 to 80% of the planned benefits. A 20 to 25% cut would undoubtedly destroy millions of retirees, but it would be far from zero. Congress has intervened before, and the last major reform was under Reagan and Tip O'Neill in 1983, when they raised the retirement age, taxed benefits, and accelerated payroll tax increases. There is no guarantee that Congress will act again, but there are precedents. What the two sides are reluctant to discuss, frankly, is the practical issue behind all this. With the United States making long-term commitments, covering retirement benefits, health insurance, and military pensions, and then financing them with a mechanism that works only if the number of workers exceeds the number of retirees. This demographic equation has changed dramatically, and no amount of political spin can change the algorithm. That brings us to what is happening now, which makes the whole conversation even more urgent. From 2024 to 2025, the federal government's net interest cost exceeded previous records interest rates, rose, and deficits continued. At present, the annual interest rate of U.S. Treasury bonds exceeds $1 trillion, exceeds defense spending, exceeds Medicare, and ranks first in the entire federal budget. As shares held within the government are redeemed at much higher market rates than the low-interest special issue securities it replaces and replaced by publicly traded debt, the interest burden will only become heavier. This is the fiscal feedback loop that keeps budget analysts awake at night. More trust redemptions drive more public borrowing. More public borrowing at higher interest rates produces more interest payments. More interest payments create bigger deficits and require more borrowing. The cycle itself is complicated, and each makes the next worse. So what happens to you as an investor, as a taxpayer, as someone who may now be paying for Social Security? You want to know if the system will last long enough to pay off your debts. This is an honest assessment. Holding debt within the government is not false or meaningless. They represent a real structural challenge, and they have begun. The shift from the era of trust surpluses to the era of trust tapering, listed as one of the most significant fiscal shifts in American history, is happening now, not at some distant future date. Without reform every year, the final adjustment will be more difficult. The composition of Treasury bonds is as important as the total amount. A country that owes $6 trillion to trusts and $28 trillion to outside creditors is in a very different fiscal position from a country that owes $34 trillion to outside creditors entirely. As those internal holdings dwindle and foreign debt rises, the government increasingly relies on the bond market's willingness to keep lending at manageable interest rates. Unlike trust funds, bond markets can and do demand higher yields when confidence declines. In fact, if you are in your 30s, 40s, or 50s, construct your retirement plan around the assumption that Social Security benefits may face some form of reduction. Not elimination, but reduction. Whether in the form of higher retirement ages means tested benefits, changes in the cost of living adjustment formula, or partial cuts in benefits, there will almost certainly be some mix of reforms. The only open question is whether it happened voluntarily through legislation or passively when the trust ran out. Building personal savings, maximizing tax preference accounts, and diversifying sources of income are not just smart financial planning. They are a direct hedge against political uncertainty. The debt ceiling fight and the credit rating scare are not pure farce, though they involve a lot. When the Treasury Department is unable to issue new debt because of legal restrictions, one of its first things to do is to suspend investments in the Federal Employee Retirement Fund and other internal government accounts. The official version of this is unusual and common, reviving the debt ceiling debates of 2011, 2013, 2023, and 2025. The government raided pension funds to keep lights on during these clashes. These accounts are fully processed afterward. But the fact that Washington often uses federal workers' retirement savings as a fiscal pressure valve tells you how to treat these internal obligations when political convenience requires them. Pay close attention to who is talking about it and what advice they actually give. It doesn't matter who tells you about Treasury bonds, because our debt to ourselves is either ignorant or deliberately misleading. Anyone who tells you that Social Security will disappear overnight is selling fear. The truth lies in between, and it requires serious policy choices that no one in Washington seems eager to make. A combination of income increases, entitlement adjustments, and spending reforms to stabilize these trusts in the long run. That is the bottom line. The $6 trillion in government holdings is more than an accounting curiosity. It is a physical record of the U.S. government's commitment to its citizens, retirees, healthcare, and healthcare for those who work for the military and the federal government. These commitments are financed by withdrawing the remaining cash and using it for other purposes, replaced by debit notes. The surplus is now gone. The money is cashing in. The real question is not whether the money is real, because it is. The real question is whether the political system can generate enough will to deliver on those promises without destabilizing the country's finances. No expert or content creator can answer that for you. The election will answer that question. The Legislative Council will answer that question. And so will the country's choices over the next 10 to 15 years. But now you understand the mechanics and the stakes. The next time someone throws out the Treasury bond number without telling you the Treasury bond number, you won't be fooled. That is what the channel is all about. Giving you information to make smarter decisions with your money and votes through the noise. If this breakdown helps you, click subscribe. See you next time.